Do you want a portfolio designed so that even when markets crash, your living expenses are never at risk? Do you want a portfolio that never runs dry in retirement, one that works for you for the rest of your life? The answer is simple. Split your assets into 3 buckets. Change your strategy based on time horizon. Why does this work? This slide explains it all. Bucket 1 is now. Secure 1 to 3 years of living expenses in cash and high-yield savings. No matter how hard markets crash, this bucket doesn't move. Bucket 2 is near future. Over a 3 to 10-year span, run a 50% stocks, 50% bonds allocation. This is the middle zone, balancing growth with stability. Bucket 3 is distant future. Assets you won't touch for 10+ years go here, 100% in stocks. Let long-term compound growth do the work. What does this 3-tier structure solve? When a crash hits, Bucket 1 means you're far less likely to be forced to sell stocks. You can let Bucket 3 compound for years without touching it. Design, not emotion, protects your wealth. This approach has been strongly supported in retirement asset research as highly effective. That said, the optimal allocation shifts based on your specific conditions. Treat the bucket strategy as one powerful design framework among several. And this is achievable. Today, divide your assets into 3 buckets. Put 1 to 3 years of living expenses into Bucket 1. This fundamentally changes how you withstand market crashes. Today I'll show you the complete blueprint. Let's start with Bucket 1, the money you need right now. This bucket holds living expenses you'll use within 1 to 3 years. Cash, high-yield savings accounts, short-term government bonds. Risk is as close to zero as it gets. Returns fluctuate in line with short-term interest rates. In high-rate environments, some examples show 4 to 5% annually, but when rates fall, that level drops too. Always check the latest rates on the day you watch this and set your targets accordingly. The target amount framework is simple. Multiply your monthly living expenses by 12 to 36. Whether you target 1 year or 3 depends on how fixed your spending is and whether you have pension income or other income sources. If you're living on $5,000 a month, Bucket 1 should be somewhere between $60,000 and $180,000. Here's the most critical function you need to understand. During the financial crisis, the S&P 500 fell a maximum of approximately 57% from its 2007 high to its 2009 low. On an annual basis, that's roughly a 38% decline in 2008. Most investors sold stocks to fund living expenses, locking in losses at the worst possible moment. But those who held Bucket 1 were far less likely to be forced to sell. You can withdraw from it for 2 years while you wait for Bucket 3 stocks to recover. But there's a caveat. Taxes, medical costs, and unexpected expenses can mean Bucket 1 alone isn't enough. Having emergency funds and insurance in a separate allocation is critical to completing this design. Bucket 1 exists not for profit, but to protect your long-term investments. Now, Bucket 2. This is where you grow the money you'll need 3 to 10 years from now. 50% stocks, 50% bonds. This allocation is the balanced starting point for most people. But the optimal mix shifts with your age, goals, and risk tolerance. Adjust it to your own conditions. It's important to think of expected returns as a range. Returns fluctuate based on market conditions. You can't say definitively, always 6 to 7%. More stable than Bucket 3's 100% stocks, but with more growth potential than Bucket 1's cash. The middle zone. This bucket serves 2 functions. First, growth. The 50% in stocks steadily builds your wealth. Second, replenishing Bucket 1. When Bucket 1's balance falls below target, you top it up from here. There's one critical caveat I need to address. In 2022, when inflation and rapid rate hikes converged, stocks and bonds fell simultaneously. There are real environments where the premise of bonds provide safety breaks down. The countermeasure: keep the duration of Bucket 2's bonds on the shorter side. Focusing on short-duration bonds, which are less sensitive to rate hikes, limits the damage in those environments. Bucket 2 is designed to grow while defending. But understand it's not a silver bullet. Use it in combination with Bucket 1's cash buffer. This is the engine of the three-bucket strategy. Bucket 3. The growth engine for the distant future. Assets you will absolutely not touch for 10+ years go here. 100% stocks. Index fund-centered management. Let me show you the numbers. What happens if you invest $100,000 at a nominal 10% annual return? This is the figure before taxes, fees, and inflation. Your actual take-home will differ. In 10 years, $259, $374. In 20 years, $672, $750. In 30 years, $1, $744, $940. This is the power of compounding. In the first decade, you gain $159, $374. But in the final decade, you gain $1, $072, $190. The back half is approximately 6.7 times larger than the front half. Why can Bucket 3 stay at 100% stocks? Because Buckets 1 and 2 exist. When a major crash hits, you draw living expenses from Bucket 1's cash. The need to sell Bucket 3 drops dramatically. There's one thing I need to be honest about. I can't say it will definitely recover in 10 years. Markets often recover over the long term, but history shows specific markets and periods that experienced prolonged stagnation. That's exactly why geographically diversified index funds, not concentrated in one country or region, are critical. Time and diversification are your greatest weapons. And the three-bucket strategy is designed to make maximum use of that time. So how do you actually allocate? Let's talk specific numbers. Here's an example of distributing $1 million in total assets across 3 buckets. Bucket 1. Now, allocate $60,000 to $180,000. If your monthly expenses are $4,000, that's $48,000 for 12 months and $144,000 for 36 months. If you have pension income or stable income, 1 year may be enough. If your income is unstable, 3 years gives you peace of mind. Bucket 2, near future, $200,000 to $250,000. Roughly 20 to 25% of total assets. Half stocks, half bonds go here. A short duration bond focus increases stability. Bucket 3, distant future, the remainder. 60 to 72% of total assets go into the 100% stock growth engine. Understand that this allocation isn't fixed. If your monthly expenses are $8,000, the target for Bucket 1 changes. If you're 60, reducing Bucket 3's allocation slightly is worth considering. What matters isn't the exact percentages, it's clearly separating the 3 roles. Check your monthly living expenses. Multiply by 12 and by 36. That's your Bucket 1 target range. Distribute the rest between Buckets 2 and 3. This is the starting point of your 3-bucket design. The final piece that makes the 3-bucket strategy work is rebalancing. Execute it regularly, mechanically. No emotion involved. None. The process is simple. First, check Bucket 1's balance. Has it fallen below 12 months of living expenses? If yes, top it up from Bucket 2. Next, check Bucket 2's balance. Has it fallen significantly below your target ratio? If yes, top it up from Bucket 3's gains. This is the cycle of your assets. Bucket 3 grows, flows into Bucket 2, flows into Bucket 1. There are 2 methods for rebalancing timing. One is the calendar method. Execute on a set date, like January 1st every year. The other is the band method. Execute when allocation drifts beyond a set percentage from your target. Either works. Choose the one you can consistently maintain. No one exception. Right after a major market crash, there's no urgency to replenish from Bucket 3. If Bucket 1 has sufficient balance, you have time. The ability to wait for the market to recover before replenishing is the strength of this design. A calendar or a rule, not emotion, drives your actions. Systems protect wealth. You simply follow the system. The most valuable thing the 3-bucket strategy provides isn't a number. It's psychological peace of mind. What is the greatest investment failure? Selling at the bottom of a crash. During the financial crisis, The S&P 500 fell a maximum of approximately 57% from its 2007 high to its 2009 low. On an annual basis, that's a roughly 38% drop in 2008. Many investors surrendered to fear and sold stocks at the lowest prices. After that, the S&P 500 fully recovered within 5 years. Those who sold didn't get to enjoy the recovery. Look at the 2020 COVID crash. A decline of approximately 34%. But the S&P 500 recovered to record highs on a closing basis by summer of that same year. Those who sold here locked in their losses too. Why do people sell? Because they need money to live. Next month's rent. Next month's groceries. They're forced into a position where the only option is withdrawing from their brokerage account. The three-bucket strategy addresses this problem at the design level. Bucket 1 holds 1 to 3 years of cash. When a crash comes, you draw living expenses from there. The need to sell Bucket 3 drops dramatically. Even when emotion screams, the design applies the brakes. Don't sell, you have Bucket 1. Wait. This is structural peace of mind. The greatest enemy of your investments isn't the market. It's your own fear. The three-bucket strategy uses design to suppress that fear. Now, let's organize the key points from today. Here's today's summary. First, Bucket 1 is the foundation of everything. Secure monthly living expenses multiplied by 12 to 36 in high-yield savings accounts or short-term government bonds. Returns fluctuate with the interest rate environment. Checking the latest rates at the time you watch this is critical. This alone structurally lowers the probability of being forced to sell stocks during a crash. Second, Bucket 2 is the bridge. 50% stocks, 50% bonds, balancing growth with stability. But as 2022 showed, in rate hike environments, stocks and bonds can fall simultaneously. Use a short-duration bond focus to prepare for this risk and mechanically replenish Bucket 1 annually or via the band method. Third, Bucket 3 is where real wealth is built. Run assets you won't touch for 10+ years at 100% stocks using geographically diversified index funds. At a nominal 10% annual return, $100,000 grows to approximately $1.74 million in 30 years. That's before tax, fees, and inflation adjustment, but the power of long-term compounding is overwhelming. Because Buckets 1 and 2 exist, the odds of having to sell this bucket during a crash drop dramatically. Today, calculate your monthly living expenses. Work out both the number multiplied by 12 and the number multiplied by 36. That's the minimum and maximum for Bucket 1. Where do you stand right now within that range? Tell me in the comments the real state of your three-bucket design and which bucket you find most challenging. Your questions about asset allocation, questions about implementation, your insights, all of it becomes the wisdom of this community. Thanks for investing your time with me today. On this channel, I keep delivering actionable roadmaps to financial freedom with real numbers, from specific wealth design like the three-bucket strategy, to the math of compound growth, to how to handle market crashes. If you want design, not emotion, protecting your wealth, hit subscribe and turn on notifications. Your wealth blueprint is right here. See you in the next one.